Welcome to episode number 36 of the Developing Dads podcast, where we discuss everything from taking risks as a dad to traveling with a child and everything in between.
How exciting does that intro sound for anyone who's
I'm not finished.
For anyone who's new here? I mean, Neil's just rattled off 2 different episodes and obviously made everyone very excited in terms of the future of episodes in this podcast, Neil. I'm glad we sold it. Thanks very much.
Yeah. There's definitely a future, but whether that's exciting or not, I don't know. But,
wow. So even more depressing. Excellent. Carry on.
Hopefully you guys managed to listen to or watch our 360 podcast, which was episode number 35. Gordon and I took a walk around Surrey, Colston to be specific. And Gordon took me on a route where there's no pavements. So if you want to see us dodging cars and cyclists, then have a look at the 360 video on our YouTube channel.
Did you enjoy the walking element of the podcast? Was that something better? Maybe if there obviously wasn't the risk of death, which Neil is slightly over-exaggerating on. He's a country bumpkin as well, so you should have been familiar to this. But did you enjoy the walking element of that podcast?
I did, yeah. It was just something different. Like I always enjoy the in-person ones. I always enjoyed doing them in different locations. So like we've done the London Bridge, we've done the bakery, we've now done a walking one. Like, yeah, I just in general, I think I like the in-person ones more.
They are way better. Because I did start, I think, before lockdown kicked in. It maybe would have been it wouldn't have been lockdown. Well, it would have been around about lockdown time or in whatever pandemic thing we were in. And I was really keen to start a fitness podcast. But I was adamant that it needed to be in person for that exact reason. Like, it's such a different conversation. Like, this is not terrible, and it's something we can get on with. But at the end of the day, like, talking to someone in person just makes such a massive difference in terms of the interaction that you're doing and how you're doing things. And yeah, everything about it's so much better. It's like Ali's one's deep dives in person. It makes such a big difference in terms of their interactions and whatnot. Like some of the guests he's had on, it's been absolutely amazing. Like, just sat listening to that conversation between 2 people. And even the people that I interviewed during the Greenhorn Fitness one, it was just so much better. So, I wish we could do them more in person, but maybe you should move to London, Neil. That's what you should do.
That goes into our topic of the week, which is taking risks.
Well, the title of it is How to Assess Risk Now You're a Dad. And the reason I chose this idea was it's just the flip of a switch direction change that you get from being an unencumbered 25-year-old, and then now, and I'm a sole providing, which you are not so much anymore. Now Laura's back to work, a sole providing father for a family, right? And the decisions that you make have an effect. And I'm just keen to explore with you how you've assessed risk over your time becoming a dad and before then, and then how you look at risk in a sense, not just essentially assess it, but what categories you see as risk. You know, you've got financial risk, you've got your own personal sort of endeavors, and how do you sort of juggle those? Like if you pursue family dreams versus your own personal dreams, how do you manage that? Because at the end of the day, one's got to give, and does it give? And it's a risk because you could then become annoyed and upset because you're not pursuing your own personal things. Anyway, we'll get into that podcast part, I'm sure, at some point, Neil. But let's start off with yours, because you've had a bit more of an eventful week or weeks than I have. So I'd love to hear all about them. So yeah, how are you?
Yeah, I'm doing good. Sitting on a Tuesday night with a glass of wine, which is a bit of a rarity for me. My mother-in-law is down for the week, actually. She's got some worky stuff in Edinburgh. And she's taken my wife out for dinner, and she felt bad. So she bought me a bottle of wine and some chocolate. So I've been tucking into that. Anyway, how's my couple of weeks been? So we haven't recorded a podcast in a couple of weeks. Last week, the first part of the week, I was actually down in Surrey, which was really nice. Obviously saw Olivia's birthday, kind of caught up in that in the podcast before this. And then after that Surrey trip, we spent a couple of days at home, and then we went over to the Isle of Skye, where we were celebrating my wife's cousin's husband's 40th birthday. They'd arranged a big ceilidh on the Isle of Skye in a village hall. It's probably the most Scottish thing you could do in the middle of an island with a village hall in the middle of nowhere. Everyone took their own drink. There's about 60 people there, 40 adults, 20 kids.
Was it quite similar to, do you remember Chapel Aguirre?
Yeah, it was like the same stage, like this Chablis Hall.
Oh, wow.
It was exactly the
So
same as that.
me and Neil both went to a primary school. So we've talked about, we've got, I don't know what episode it was, Neil, but it was talking about us living on a farm. But basically we went to this primary school that had 25 kids, something about that, like in the entire school. Like when I tell people down here that I was in an entire school of 25 people, first of all, they're like, where the hell where was the tax money going? And then the second one was, well, how big was your class? And like our classes were maybe 5 or 6 or 7 people, but it was like a little tiny village thing. And they had a village hall. And it had a stage on it. You'd have birthday parties there, and they'd have hogmanay there, and they'd have hogmanay, by the way, is New Year's, and they'd have like parties and all sorts of bits and pieces. And it sounds a bit like that, where the whole village comes together and you eat vol au vents and prawn cocktails.
You did well. Everyone took their own dish, so you either got to choose. You could take a dessert or a main course. And there was a barbecue as well, and yeah, it was just an awesome night. Like really, really good. Lots of laughing, lots of hilarity, and the kids loved it. And then we spent a lot of time in the beaches, probably a highlight actually. I got up Sunday morning relatively early with the kids. We went out the house for about 7:30, took them to this beach on Skye. We stopped off at Co-op just to get a few freshly baked croissants, took them to a beach, and the tide was in, which basically means that there's not much beach to go roaming in. And there was 3 otters just playing around in the water right in front of us, and we sat down, ate our croissants, and the otters were just like going up and down the water and like showing their faces. And like those moments, like it cost nothing, like £1.50 for my croissants, but the kids absolutely loved it. I was in my element, and yeah, that was a good dad highlight.
Nice. That it sounds like one of those things where I reckon otters would just become like squirrels if you lived somewhere like that.
Yeah,
you'd be like, oh, there it is. There's the lovely looking otter just kicking around. Whereas now, because you don't get it too often, it's like, oh, that's lovely. It's a nice little treat to see. It's like, an elephant in the savannah. But really, our driver who was driving us around in Kenya or in the Masai Mara, he was just like, yeah, these are just
sees them every day.
These are just big pigs with things. Yeah. Anyway, sorry, I've deviated. Carry on.
And I worked from Skye, so flexibility of work. I had a day working in Skye, which was hard. I mean, knowing all my family and like my friends and stuff were out in the beaches, that was hard to work there, but it was also refreshing. So I got it was quite productive. And we came home Sunday night, and my car is now fixed. So if you're a long-term listener, you might realize that 7 weeks ago my car went to the garage, quick fit made a mess of it, and I finally got it back.
Wow, Neil, that's the best news I've ever heard.
Yeah. Oh, and in between all that, I got a Volvo Xc60 twin turbo hybrid machine to drive around in for the last week. So
I bet you're delighted about going back to having a shitty Citroen C Picasso, whatever it's called.
Yeah, 7 seats.
How was it? Was it a nice car, the Volvo thing? Would you buy it?
It was. I mean, it was. It still wasn't big enough for three car seats.
Oh my word!
Which is just mad. I would buy one, but like it was 75 grand. I looked it up in the spec we had, and that's a lot of money for a car. Whether it had 75 grand worth of stuff to make me wow, I don't know. I loved the fact that when we're on single track roads, I could stick it in sports mode, and literally like you get thrown back in your seat. The kids loved it, and you could overtake really fast.
Obviously within speed limit.
Obviously, and the kids were constantly like, "Dad, put it in the go faster mode." Because it lowers, like the suspension. I'm getting excited now, but the suspension, the car actually lowers, and then you just zoom off.
Well, and they have plush leather seats and stuff like that, and all that kind of thing.
Yeah, massage and heated seats. Well, I didn't need heated seats because it was roasting, but off-road mode where the car like goes ridiculously high, and the kids are like, "Wow!" Yeah, it was just a fun couple of weeks. So like, quick fit, although they mucked up my car, like I'm going to write them a review because they basically they gave us 60% off the final or 70% off the final bill of the car, and they gave us they tried to upgrade us loads for the higher cars, and like every couple of days they check in with us. Got a call today to make sure my car was okay. So like, yeah, although it was 7 weeks of not having a car, the customer service and was decent.
I mean, they did break your car, so that's not a good part of the review. Let's be honest. It should be like a 2.5 out of 5.
Yeah, I mean,
you would have had your car back if they hadn't broken it. Then you could have given them a 5-star review, but they fundamentally broke your car.
True. Anyway, how's your week been? What's the house update? I can see you're still not in the house.
I am still not living in my own house. I was thinking about it today. I can't believe that I think I've paid a number of thousands of pounds to the bank for my house, and I've not even lived in it, which feels horrible. And then equally, we've been using David and Denise's electricity and whatever else, and space and time for the past 5-6 months, whatever it's been. I'm bloody over it. I'm tired. I'm just tired of tradesmen who are just like, today we had a flooring guy in we're getting our floor done. And we delayed moving in until basically Friday or Saturday this week, because our floor is this Antico Spacia something or other, which is like, it's fancy like plastic you put in your floor and it looks like wood. So anyway, we've got, they first have to put down some plywood or something and then screed the floor and then lay a latex layer and then glue the thing on, and it's all very complicated, but it's in stages, right? So they basically get to that point where they glue the floor, or they latex the floors, it's all flat and it's all lovely. Then they start the gluing process thing. Well, the guy who was around today didn't do all of that, he only did a little bit of it, and we were expecting, obviously, this glued latex layer. He also took a chip out of my plaster in my wall. I didn't say anything.
Wow.
Yeah.
Oh my God.
Not happy. So I sent a very disgruntled email, and I was like, "Do you realise you've damaged my wall? I expect that to be fixed and painted. Thank you." So, but this is a story of this house building process. Like, not one tradesman, even the relatively good ones, not one has necessarily been, 5-star review on Google, because they're either really late, they don't turn up, they've broken something, they don't tell you they've broken something, they fit the wrong thing, it's put on squint, the thing's glued in the wrong place. Like, I don't know. Like, I can't believe I've met so many people that have just like.
I think it's a fundamental thing that's missing in, like, I don't know if these guys go to college or do a apprenticeship, but like managing a business or like good customer service. Where's that in the module?
Oh, but even if it gave me bad customer service where they were rude to me, but they did an amazing job, I wouldn't care, because it's the outcome. Yeah, okay. It's the outcome I'm looking for. I'm looking for a nicely put together house. That's all I want. That's watertight and is done at a reasonable price. That's all I'm asking. Like, you can do that. I'll give you an entire week to do one of the jobs. I just want it done, and I want it done to a high standard.
Yeah.
So we're still not moved in, and hopefully, fingers crossed, we're in tomorrow, on Friday and Saturday. But I don't know what this flooring people are doing. Then, well, I had to look at my calendar to see what I was doing. But you came down. We had my daughter's first birthday party. She wasn't actually one, but she did turn one that week on the 11th, which was cool. I was working, so I didn't really get to see her very much. But I got to see her in the morning, so we sort of did a bit of present opening and just playing a little bit, and then she went to the farm thing with Laura and walked around it, because she's got basically one of the baby and bump or NCT class thing. One of them's other kid was born on the same day, so they were 11 and were born. So born on the 11th.
Cool.
So they're sort of birthday twins, if you will. So they went to do that, and then we didn't really do much after that, really. It was kind of like the weekend. We had a bit of a barbecue thing, and then we had some dinner with some friends and whatnot. Laura's just coming in to try and steal some things. She won't want to be in the pod. She's moaning at me now because I'm doing the podcast in here. She wants to go to bed. Oh dear. Well,
live on air.
That's live on air, exactly. I'm getting told off by my wife. Here we go. Anyway, so we had the birthday thing on the 11th, and then we did some bits and pieces, and we had some dinner with some friends, and then we had a barbecue thing that we had on the Friday, and now it's like Tuesday. But beyond that, didn't really do a whole much. I think it was just kind of like a week of a bit of work. I've been putting some feelers out to get some new clients and things from the freelance perspective, so that's kind of been pretty fruitful. I'm working with someone in San Antonio, Texas, on a course. So I'll be editing the course for them. And then I had a good call with an IT chap, actually. He sold his IT business and now does tech, YouTube, consumer stuff. So it looks like we're going to be working on some projects for that. And then another old client who messaged me wants to sort of pick up some work that we were doing previously in terms of like exercise libraries and things. So that feels pretty good. So yeah, it feels pretty good. Like that's kind of, it's just been a relaxed, interesting kind of week of house stuff and just driving up and down to the house every 5 minutes because Laura was on the phone to Wren Kitchens for an hour and 45 minutes just to get someone to tell her about, because we got a sink. They fitted a sink squint. Oh, I don't know. But that's it. Anyway, we should move on very quickly, Neil, shall we?
Yes, I think we should.
Okay, so how to assess risk now that you're a dad. And it's not something like, if there's someone listening to this who's 20, 21, 22, 23, 24, doesn't have a kid, doesn't have anything at all. I think I largely assess risk at that age of, can I afford it? Because obviously there was kind of limitations, right? I can't just go and do whatever I exactly wanted. Did I want to do it? And then just kind of went ahead and did it. I didn't really think about, well, is this going to benefit me in the future? Or is it not? Is it good? Is it bad? I was just kind of in the process of doing, and there wasn't really sort of risk assessment as such. It was more a feeling of, this feels pretty good, I'll do that. And
yeah.
I
feel like when you're early 20s, I mean, I had my child when I was early 20s, so late teens, 18, 19, 20 for me. Like, you have a very narrow view of life. I don't really remember thinking of like bigger picture and what's this going to mean in 10 years time? What's this going to mean in 20 years time? Is it going to be okay for my retirement? But as soon as you have kids, and as you mentioned right at the start, it's like a flick of the switch, and you need to kind of change your attitude towards things. So yeah, I think in my early pre-kids, I just lived each day as it came, and maybe thought, I want a holiday in 3 months' time, or let's go on holiday in 6 months or next year. Let's book it, pay for it.
And like financially, did you sort of think about, I need to save this percentage of my salary and put that away, and what's my pension thing doing, and how much am I getting charged for it? Were you thinking about any of that?
Yeah, there was no pension. I think I was pretty clued up with. So I've never been self-employed, so I've always had a pension through my company that I work for. It was public sector for a while, then it moved to private sector, and I always maintained like I invested in my own pension, so I had to obviously go through their funds and stuff, but I never let them do it for me. So I was always quite switched on with that. In terms of like saving for the mortgage, like for a mortgage for a house, I remember that was like quite a big thing. So like Rebecca and I used to put money back every month, and like I guess that was the longest I'd look in the future. I'd be like, right, in 5 years or 4 years time, 3 years time, I want to buy a house. It's going to roughly cost 175 to 200 grand. I need this much for deposit. So like I did that very high level calculations, but that was it.
Yeah, I didn't. I really sort of spent what I earned, to be honest. Like it was, to be fair, in my early 20s, I wasn't earning very much, so it was kind of quite difficult to save. But then even then, when I was earning really good money doing the online and personal training thing sort of in my mid to late-ish 20s, I still wasn't overly conscious of saving money. I guess I was kind of, conscious of making sure that I made enough, but I just made more, I guess. Or I was just trying to hustle to make more. And I didn't really think too much about financial things. But there wasn't sort of forward planning of like a pension, or forward planning of investing in the stock market and researching that kind of thing. I guess it just wasn't, perhaps maybe the research wasn't quite available then. And even at that point, I think thinking about getting a mortgage, again, I couldn't have told you like the variable types of mortgages that I could have got, or the types of loans that I could have got, or I think I got a credit card because you got points on it and you got money off like Marks and Spencer's shopping or something at the time. But again, I didn't really think about credit ratings and all that kind of thing. There wasn't really a risk assessment necessarily. Did you think about like job security at all? Because obviously you've been employed most of the time, but you obviously went from public sector to private sector. Did you ever think about the risk aspect of like changing that? Because I know you said in a previous podcast, some of your previous public sector work colleagues were like, "Oh, you're going to fail. You're off to doing that," and blah blah blah. What was the dealio on that?
Yeah, so I think I was chasing money, like in all honesty. So public sector is renowned for the base salary not being that great, but your pension's amazing. You get more holidays, and there's better perks in that way. But yeah, I was kind of chasing money, and I was kind of chasing a better career. Yeah, and as you mentioned, I do remember some of my colleagues in the older generation probably never listened to this, but yeah, they're just like, "Oh, you're going to regret going to the private sector. You'll be back in the public sector soon." Blah blah blah. I'm like, I've never looked back really. Like, and if you look, the public sector now isn't so lucrative. The pensions are smaller. They've actually cut. There's something in the news actually yesterday where they've cut the, if you take your pension out or early or whatever, they've almost halved the amount you can get. Or there's something weird that's really, impacting the public sector. So.
And you don't get any control over that pension. I don't think it just goes into the big pot and it's managed by someone else. Whereas when I'm self-employed, my company can pay into my personal pension, which is my self-invested personal pension, I think it is, and I can decide where it goes. So then I can then assess. Well, okay, I'm not necessarily a financial advisor, and this isn't financial advice at all, but I can make the choices based on like cost of funds. So some funds charge at 1% plus then the actual fund itself, or the management fee is 1%, then the fund is like another few percent, and you end up like losing. I think we talked about this on this calculation where you're like, over a lifetime of mortgage, you're losing like 30 grand in fees, which is so much money, and you could be doing that in the public sector. But I guess and
also base salary in public sector. So for a similar job, I got something like 70% pay rise just by moving to private sector. So wild. Cash now outweighs the kind of the pension.
Yeah, and we had both parents. They worked in the public sector, and I remember Mum always talking about it's more secure, it's more safe, and I guess at her time it probably was, because you got a big pension, you got your big payout, you got your 60 days paid holiday or something crazy after a certain amount of service, and all these kind of benefits that you just wouldn't really get in the private sector. And there's the job security. Like, most people don't get fired from the public sector necessarily. But at the same time, I think I'd just rather have more money, to be honest, and take the risk.
And that gives you freedom because you can invest in it. You can do, 70% more at age, I was 20 at the time when I moved. That's massive.
Yeah, that's definitely huge. My risk assessment then for job stuff was just kind of like, again, similar to yours, was I think Rich Dad, Poor Dad said that when you're young, certainly when you're 20s, you should work to learn, not work to earn. So you were chasing money, I suppose, but maybe there was an element of like progressing in your career a bit more. You didn't want to just sit in desk and doing that same thing every week in, week out. And I guess that's the way I took it was, well, my assessment was, what's the worst going to happen if I move to London? I lose all my money and then that's it, it's done. I'll just move back to Scotland. But I would have learned a lot, and that would have made a huge difference in terms of my progression potentially and whatever else. So, yeah.
Yeah, and I think that's a pretty solid advice. In terms of when you moved to London, because that kind of leads us nicely into your late 20s, mid 20s. I can't remember when you moved. How did you assess that? How did you weigh up the kind of pros and cons, the risks associated with moving to a city which is like, I don't know, house price wise, rent wise, probably 3-4 times more than Aberdeen?
I think there wasn't that type of assessment. Like, I wasn't looking at working out how much it was to rent and then all these kind of things. It was literally, if I stay here, these are my prospects. If I stay in Aberdeen and I work in Nuffield Health, what am I going to achieve? I'll earn probably a similar kind of amount. Like, I think now actually in Aberdeen, personal training rates are still the same 10 years later, roughly. If you think that they should be at least 30% more, as a 3% inflation rate. So 30% more, if we were charging like £35 an hour, give or take. So they should be what now, £50 an hour? There may be that, probably not. So, there's that kind of thing. But you're just thinking about that. And I was thinking about, the prospects of me living in Aberdeen. I was going to live there, and the whole economy that's up there with the oil industry and stuff like that. And I was just like, this can't be the thing that I want. And the downside is, if I just stay here, that's all I'm going to get. It's not necessarily going to progress any further. But if, for example, I move to London, the upside is too high. Like, the asymmetrical aspect of it is, if I stay here, it's going to be rubbish. But if I go here, it's going to be unbelievable. And it could go to the absolute stars. And the downside is, maybe I just come home. And that was kind of how I assessed it, basically, was that there was just too much of an upside moving to one of the biggest cities in the world.
Yeah. Was there not a point in time where you thought about America as well? Or am I just imagining that?
I did, but I think that was like a pipe dream. That was like one of those kind of like, I went on a holiday and I was like, oh, this would be amazing to live here. But then if you actually assess America, especially when you look at things like their social care, which doesn't exist. So if something did go wrong, that's pretty bad. Because if some people have like a minimum payment of like $2,000 or $3,000 or $4,000 or $5,000 for the insurance company to pay out. So you have to stump that up, right? You'd have to stump that up, and that could be a random freak accident where someone breaks your arm. Not good. So it's things like that type of assessment where I'm like, well, okay, America would be fun and it'd be a bit of a pipe dream, But at the same time, I think I'm doing all right in the UK. I'll stay here.
Yeah. No, I think that's right.
But I guess like part of me was kind of interested when we started on sort of a financial aspect of things. When you first bought your house, were you pregnant? You're just
Yeah, I was born.
no. So
Yeah.
but were you pregnant when you applied for the mortgage?
No.
So how were you sort of assessing what kind of mortgage you were getting, how you were doing it, how long it was going to be for, like what were you doing?
Yeah, there's no kind of assessment. I just let me try and think. How did I get? Oh yeah, I think we just went into, I can't remember, was it Barclays or something? Like we looked around on the internet and like looked at deals and stuff, and then just decided to go with Barclays and went into their offices. They did an affordability check. I knew I was earning good money at the time, and I knew like from looking at calculators online that what the monthly payments roughly would be, what the difference in terms of variable rates, paying on interest only, and all that kind of stuff. So I'd done my homework, and yeah, like it was quite a. So it was just like, this is the next stage in life. So I was paying rent, albeit I think the rent was similar to what my mortgage ended up being. So I knew if I could afford rent for the last 4 years, then my mortgage would be no problem. So there wasn't much thought to it.
And did you like seek out any advice, or were you just like, yeah, this is this much and that's how much I need to pay, so that's fine? Or did you like find out from any friends or family or stuff that you were like, should I do this thing? Is this a good idea? Or is it not? And if you didn't, why not?
Yeah, I'd probably naively didn't. I knew kind of what 25 years, because that felt like an okay number. Maybe you told me that, or somebody told me that. But apart from that, like I did do my homework in terms of different rates, and like made sure that I'm not paying crazy interest on my first mortgage. But there's no real kind of going back. Maybe William helped me, my father-in-law. Yeah, I can't remember really relying on anyone to help me.
Because that's the hard part as well. Like when you're assessing something to whether it's risky, if you've got someone you can rely on or people that you can rely on, where you can go, I'm thinking about doing this thing, and you can kind of go down a route of exploration, which I actually find really helpful when someone does that, when they kind of like poke and prod your idea, because you can get like with a house, like I typically find, or anything like a shiny object, like a car, for example. You can do PCP and you can do finance stuff and all that kind of thing. But you can get like wrapped up in the shiny object syndrome kind of thing. And you're like, yeah, I can do this, I can do this, I can do this. And it's like, yeah, I can afford it. Yeah, I can do this. Yeah, I can do that. When it perhaps takes someone just to say, hold on a minute, is this a good idea for these reasons?
Yeah, no, I think it's a really good trait, and I've probably matured now enough to do that. So any kind of big purchase, if it is ever to buy a house again, or I don't know what my next big purchase would be. Maybe an extension to this house.
Volvo Xc60.
I'd get advice, but at the time when I got my first mortgage when I was 21, 22 maybe. No, 23 when Isla came. Yeah, 23 years old, I got my first mortgage. And I wasn't really switched on in terms of, is this a risky thing to do? Is this stupid? I wish in hindsight, like looking back in the house I bought, and we've done an episode on biggest failures or biggest regrets, or something like that. The house we bought in Inch, it was beautiful. It was a new build. It was from a kind of small town house builder, so it was really good quality, but location was rubbish. The type of house it was, so it was like a flat, but had its own front and back doors. So it was all a bit strange. I wish I'd asked the question, even if it was to you or to a friend, like, is this a good idea? Is Inch a good place to live? Would I have listened? Don't know. But
that's a reasonable piece of advice, right? When you're young and you're trying to make big decisions, you should seek out someone you see has either done it before, or is willing to ask you questions, not necessarily like bestow stuff onto you and tell you exactly what you need to do, but maybe saying things like, yeah, is this a good location? Is this, do you think this is a good mortgage provider? Is there any ones that are cheaper? That type of thing doesn't necessarily push your agenda onto them, but it makes them go, well, I don't know, actually. Maybe it is, maybe it isn't. Yeah, financial for me, I've definitely matured in terms of my finances, even just from like a dad perspective. I'm now genuinely thinking about 5-10 year plans, even potentially looking at, well, I want to retire when I'm 55, right? So when I was buying Downham, it was nowhere near a financial decision. It was kind of, or it was a financial decision, but it was more a case of, I knew it was near a train station, because I won't get into the details of this, but I knew it was near a train station. I knew that the mortgage was definitely affordable overall. It had a driveway. It was desirable because it had a garden. It was in London. It was like 10, 12 minutes to London Bridge. Like, there's a lot of going for it. But the area itself was horrible. Like, it's, it's got, people get stabbed outside chicken shops and all sorts of things. It was not a nice area. But I knew it had potential. So I was like, look, I'll just get into I'll afford it, get into it, and then just find a way to pay it off or pay the mortgage or whatever else. Just because I knew it would be an upside. And lo and behold, my bias was confirmed, where it was going up at like 12, 14% a year for the best part of like 4 or 5 years. And then the next thing that I did was I decided to think about, okay, well, if we're going to have kids, I was thinking, right, what's the biggest hack anyone can do when it comes to having kids is move near your in-laws or your parents. Not next to them, but at least within some sort of reasonable distance, because just having that afternoon or having that break would make a big difference. And then I guess I was kind of like just assessing, we got lucky. Like a lot of this, I got lucky, I feel like. I was just kind of at the right place at the right time, where we had stamp duty relief at the time and all this kind of stuff. So it made it easier to purchase properties. But I was definitely much more bullish on making sure that we didn't overpay. That was one big thing where I was like, no, we've got a budget. We have to stick to it. That's how much we can do. And that's kind of where I laid it. And then I guess some other aspects of the financial things, like just thinking about, well, where do I think I'm going to be in the next 5 or 10 years? And for me, it's going to be having children, raising a family, earning money, just finding a stable base, putting some roots down, if you will. So keeping both the properties seems like a good idea. I can afford them because I've done some sort of financial looking at it, and it's hopefully going to pay off in 10 years. we shall see. So I don't really know how I assessed it, but maybe you've got a question on it or something. I don't know.
Just an interesting side thought is, like, I guess in our 20s, we didn't obviously have a wife. We might have had a girlfriend. We didn't have any kids. So, like, you don't need to. There's no need to plan for the future. And there's still the unknowns of, like, will I be able to have kids? Will I even want kids? Will the partner I marry want kids? And now we've got that. Now we've ticked those boxes. I feel that it's just almost like a natural progression of, like, you start thinking about the 5, the 10, the 15-year plan. Yeah,
that's definitely fair. Because, you're sort of settled into a routine and a thing, and you know what you're potentially going to be doing for a number of years. Oh, you have to, basically. Like, you have to afford this house now, Neil. You've bought it and your kids live in it.
Yeah.
But then, I would think about, where, and I guess I didn't, but I was definitely more conscious of it, where I'm like, do I, at my age, leverage myself as much as possible? Like, if I really consider how much debt I'm in, including mortgages, I'm £600,000 in debt, which, saying that out loud, I'm like, holy crap.
Yeah, what does it actually mean though? Like,
well, it means I'm in £600,000 worth of debt, Neil. Like, I don't have that money. I'm paying that money off. Like, someone's let me borrow that from the bank.
Yeah. Okay.
Which is kind of scary, because I'm like, okay, so what do I do in my 20s, and basically up till a certain point, your salary just generally sort of trajectory goes upwards, right? You get more experience, you get a bit older, your wealth builds overall because you've been saving or whatever else, but generally goes up. So basically, I think it was a case of you have lower outgoings and more money when you're nearing retirement than at any other point in your life.
Yeah.
Like, you've got your highest amount of experience, the highest salary, and you've got the lowest outgoings because you've paid off your mortgage and your kids have all moved out. So what I was considering was, well, do I leverage myself as much as possible as I can now? Because house prices are obviously fingers crossed, only but going to go up. So do I just like put myself in loads and loads of debt and just try and afford it and pay for it because low interest rates and all that kind of thing? So that's part of my assessment. And I was like, yeah, I think we should, because that sort of steady growth in salary will always go up at some point. I may never get this type of opportunity to be able to leverage that type of debt. And then when you're leveraged, you can ultimately see more gains, because if you've got 10% deposit in the house and the house goes up 10%, it's the total value of the house that goes up by 10%, not just your actual thing. So that's like 75% increase, 70% increase potentially on your investment, which is huge. So I was like, yeah, let's do that, because I'd like to see those dividends paid, in 10 years' time when I'm trying to buy a massive house, and it's one that I want. I guess what I'm doing here is I'm assessing risk from these are my goals, how do I get to them? And is that potentially feasible? So my goals aren't necessarily so far ahead that I want to be buying an island like Richard Branson, because I don't think I'll ever get to that point. But they're not so unrealistic that I don't think in 10 years' time that I won't have been able to achieve buying £1 million house. You know what I mean?
Yeah, I definitely know what you mean. A bit of a question on that one. Have you ever thought, like, so going into my career and project management I did for a while, and we talk about risk in projects quite frequently. Obviously, that's a big part of managing projects. And if a risk materializes, so if you, for example, forecast or you raise a risk, so to speak, that the financial markets are going to crash, and you almost play out your scenario. If that happens, then what do you do next? Have you ever thought about?
No. No. I never think about losing a job, or I never think about not making money, or the financial market, because these are like some of these things we're talking about there. The market collapsing. In 2008, for example, in London specifically, in 2008 the market crashed. Okay, fell through the floor, and so did the housing market across the UK. Some properties dropped by about 10 to 17% or something. It was quite a lot, right? People were going into negative equity. But at the same time, like, these people had taken out 125% mortgages, right? There was a self-assessment aspect to it. Like, these people were just saying, I earn £100,000, so I'll have this house. These are dumb decisions. And that, I guess, assessing that, I'm like, you took out too much. If the interest rates went up, or something happened, or you lost your job, you're so hard leveraged that you literally have no money. You've got nothing in the house. Like, there's no comeback. Because, so from my perspective, again, if the market crashes, and one of my points was that the house prices went down across the UK by some substantial margin, in London they didn't move. They stayed the same. So it's like, I guess my assessment of the risk is I look at the things and I think, okay, let's say I lose my job. I've got at least some sort of rainy day savings. I've got 3 to 6 months in the bank to make sure that everything's covered. Generally, my normal lifestyle will be covered. I could sell a house in 6 months.
Yeah.
And then the deposit that I have, like Sherwood Road, I have a deposit of 15% in it. So that's quite a lot of money, which I could probably rent on that for the next, 2 years, if necessary. And again, based on the whole 12 years of being self-employed, I've managed to make money. I've managed to do something, right? So I guess the assessment of risk is basically, what can I control? And things that I controlled were having some sort of savings, not leveraging myself to the point where I was literally like all money. There was no money in my bank. Everything was on finance. I didn't take out things that were silly finance in terms of cars. Like, my car's bought and paid for. It's not the biggest and fanciest, the Ford Fiesta, but at the same time, I own it. There's no finance or anything on it. It's also a car that is easy to service. It's cheap to service. The wheels, the tires cost like 60 quid. I'm not buying a Porsche or a Tesla where the wheels are like, the tires are £250 a piece. But you see what I mean? Like, it's these types of assessments, I guess, I go in my head from that perspective, where I'm not making myself bulletproof, but I'm pretty sure as hell going to dodge bullets, because I've got these types of things. I've thought about that kind of stuff.
Yeah. It kind of comes, like, I think people generally know if they can't afford something, and people generally know if putting this on a credit card is probably not the best idea, but they do it anyway. And I wonder, like, I guess my observation of that is it's probably a materialistic thing. So, flashy nice car, Range Rovers on finance, relatively easy to get. I could probably go out tomorrow and get one. I've got Amex with a, 18 grand, 20 grand spending limit on it. So all these things you could easily get into debt, and people do that. But I think I think they understand the risk and they understand they shouldn't do it, but they do it anyway because they want that buzz and they want that kind of validation of the external validation of.
I'm curious if people actually do know the risk. Like, do they truly understand what can happen? Because they're not. If you took out that car loan that was for a Range Rover that was pushing you over your limit a little bit or getting you very close to it, then you're not really thinking about it. Like, surely people don't think like that, Neil. People don't think, God, yeah, no, maybe I can just afford this. I'll be okay. No, they go, I deserve it because I've worked hard and everyone else has got one, so I deserve one too. It's like keeping up the Joneses thing, and unfortunately, it's with Instagram and whatnot nowadays. So, yeah, I don't know. I don't know how I feel about it, but yeah. Did you ever do anything like that? Where I was thinking about, when you buy a car, I'm thinking about like the wheels, and I'm thinking about like the fuel economy and that kind of thing, but also thinking about my house, where I'm like, I try and lock in as much as I could. Like, I was curious about this whole inflation thing that was pre-inflation. That was like last year when I was thinking about mortgage. I was thinking, well, if people got lots of money, like, I'm not an economist, I have no idea what I'm talking about, but I guess it was my rationale and assessment was, if people got all this money in their bank account, they're going to buy lots of things, and we have supply issues. Does that not affect inflation? And how do banks then curtail or slow down inflation? They usually raise interest rates, because you've seen that in like the Great Depression back in the 1915 or stuff like that. Like, it was 2 Great Depressions, sort of in the 30s as well. That's what happens. So then people's like spending gets squeezed and all that kind of stuff. So I was like, I should probably lock in a mortgage rate that's really low, or lock in as long as I can at these really low rates. So I did 2 5-year mortgages, whereas previously I'd only done 2 years. So yeah, that was basically my thing.
Yeah, so like, I guess two points in my life where I've had to kind of sit down and draw out on a bit of paper what the worst case scenario could be. And the first one, we did a podcast, we discussed this already, but when I moved down to Edinburgh, or took a job in Edinburgh when I was living in Aberdeen, was made redundant, like moving complete different locations, I had to seriously think about, like, could we afford the flat or the room I needed to rent? Was it a worthwhile decision? Like, that was quite, and that was a risky move, because I didn't know if the oil price would recover. I didn't know if I'd enjoy it. Like, I'm glad that all worked out, but
I partly think that situation was an acute thing, rather than necessarily like a future prospect thing. Like, it wasn't a case of, hey, is this going to make...
Yeah, you just had to do it.
You just had to do that shit. Like, you sometimes you just got to pull your trousers up and off you go. Like, there's no preparation, there's no planning aspect of things. So yeah, I don't think so. But I think there's a few other things that I was kind of quite interested in, especially when like becoming a dad, and there's an element of like friends and relationships and stuff that I find quite interesting, where we both not necessarily been people who have got huge friend networks, but I've seen this in other dads that I know, where you end up like kind of shrinking your circle and then just staying in it and nurturing that little circle more, rather than having like flippant night outs or going out and doing some bits and pieces, because the risk on that is that you're just wasting your time, and that time could be spent somewhere else, like with your kid or your wife and your kid. So do you think about that type of thing, where I risk losing friends? Like, if I don't maintain these relationships or go these like flippant night outs or whatever else, I risk losing a friend. But then how did you go about considering that? And did you consider it at all?
Yeah, no, it's a really good question. And yeah, I've only got a handful of probably really close friends that I would probably go out my way to meet, to go out for drinks, to have a meal with. And there's the kind of the other sideline people where, as you say, you'd rather spend time with your other good friends or your family or your wife or your kid, or save the money. Like, money in it for me anyways, I wouldn't say it's ever been tight, but certainly money's always been on my mind for the last 5, 6, 7 years. So a night out, to me, I've got to kind of validate, is it worth spending that money that is not in abundance, and is it going to bring me happiness? So yeah, there's definitely a point, and there's definitely a place I do review. Where I kind of go a bit rogue with that is, and like I've done this, and whether it's contributed to my success, who knows? But even from a very, very young age, when I say young age, when I moved to the private sector, I was always up for a night out with like people from my work, whether it was the level up, the C level, the CEO, the executives, or even if it was just the same level as me. I'd always say yes to going out with colleagues and bosses and people like that, and I still do that to this day. So was it 2 weeks ago? I was out with the COO, Chief Operating Officer of Proteus, the company I now work for, and I had the best night ever. Like, although I mean, thankfully or gratefully, he paid for it all, but he didn't have to, and I was prepared to kind of go out my way. Light just turned on. Go out my way to pay for it, and I didn't really know him, so I wanted to spend some time with him. But I guess I kind of, if it's to do with my career and if it's to do with work, I will prioritize that over friends that I don't really want to see.
Yeah, because there's the upside, right? There's the, but then it's that balance. I find, I've talked about it in this podcast before, is the balance between where do I spend my time, I think is the question here, and how am I balancing that risk? Having loads of friends is nice, but it's about close connections rather than lots of people, right? It's about the impact that you can have on 5 people rather than 500, and the connection and enjoyment that you get from those conversations and things. And then it's also like that balance of your career, right, as well. What you're talking about there is and balancing those relationships where, sometimes those relationships come over and above family, because the upside is probably pretty big, not just for you, but for everyone else, right? You're going to get a success from it. You're going to get something from it because you'll get maybe a better relationship with your boss, which might mean more money. It shouldn't be that way, but sometimes it is that way. Like, it's the way it is.
Yeah.
Maybe you have to work a little bit later because you're working on a project with another colleague or whatever else. So I guess that's kind of interesting where you're sort of balancing that risk where you're like, look, I've got to do something, and if I'm going to do it, it can't be necessarily at the detriment of my family, but if it helps my family's future, then ultimately it's a good thing. And if I know that this friend is someone who's reciprocal in terms of their friendship and they give as much as you take or they take, then it's a much happier place, I guess.
Yeah, no, I agree. I mean, there's definitely been nights, more than I care to admit to, that I've texted Rebecca saying I was going to be home at 10, but it turns out to be 3 a.m. because the nights turned out to be good. Generally, it's a work night out, but that's just, I don't know, like...
Do you justify it? Do you justify the night out because it's a work night out, though, Neil?
Yeah, career.
We've all done it.
Yeah, but like, and I see myself as relatively successful compared to my peers at 31 years old. So yeah, I think that's got, I don't know what percent in terms of my career progression and but I've made, like, I've had some great chats, some great relationship building with people on a drunken night out in my career.
Such a boys' club.
Yeah. I don't know if you can say that anymore.
You can't say that now. You're definitely describing a boys' club, Neil.
Yeah. Okay.
So we've done sort of finances. We've done a bit of relationship stuff. I'm curious about like the future aspects and how we're looking at what we're doing now versus what we're doing, or how that could affect our future selves. Like there's a podcast with a chap called Will McCaskill. He's done one with Tim Ferriss. He's done one with Ali Abdaal. He's done one with Chris Williamson. And basically his thing is something called effective altruism. So he looks at, say, charities, for example, assesses how much money is being used effectively. So how's it saving lives, for example, like mosquito nets apparently are very well, good buck per save life trend aspect of things. But then equally, he wrote a book called, I'll actually tell you just now, What We Owe the Future, I think it is. Basically, it's about, what we owe the future. Like, it's out on September the 1st. Yeah, hashtag not sponsored, unfortunately. But basically, he talks about the idea of, the what we do now, if it affects someone in the future, it doesn't necessarily mean it doesn't mean that their morality is less than ours. So if, for example, we could stop a Holocaust today, we would do it, right? If we could stop it in 10 years, we probably still would do it. But if it was 100 years, if it was 1,000 years, if it was in 10,000 years, you'd maybe have a different answer, wouldn't you?
Yeah.
So my
definitely.
question is largely around this idea of how are we assessing what we're doing now, and how does that potentially play a risk in the future? Like, are we exercising? Are we saving some money, like I said before, in terms of our 6-month thing? And how are we assessing the risk of not necessarily doing that to satisfy our present selves versus our future selves?
Yeah, so I'll take that 2 questions. I'll take the kind of the health one and that side of risk, and the financial one separately. But the health one, it's probably come into, I didn't think about it when I had Isla. I was still running when I had Isla, but more so when I've had the boys, and I've got 3 kids now. I don't know why, whether it's my maturity or what, but health is a big thing. So I do watch what I eat. I do like indulge in alcohol every so often, but never to the degree of like being legless and paralytic. I just don't see that anymore. But yeah, my daily runs, my cold showers now are all thinking of the future and making me my best self for when I'm 50.
The getting hammered thing is quite an interesting one. Quite an interesting one for those who are not dads. You basically just can wallow in your own self-pity. But when you've got a kid who's smiling at you and you feel horrendously guilty because you're so hungover and you can't play with them, and they don't know why you can't play with them because you've been drinking the old evil sauce, then it just there's just, again, it's that risk, that balance of is drinking 10 pints of lager now as fun as playing with my kid? Probably not.
Yeah, and just like even the health implications. I know it's probably not long term if you do it once a month, but I mean, I've got dads that I know of that are out most weekends drinking a hell of a lot of alcohol and just not living a very healthy lifestyle, very sedentary, and they're definitely not looking to the future in terms of their health. And in terms of kind of financials and having money in the bank, I've taken a bit of an interesting one with that. So I joined a startup 2 years ago, and at the time I didn't have any money in the bank. So like, if shit hit the fan and that startup ran out of money, well, the worst case is, I think I calculated that it'd probably take me 4 to 6 weeks to get a job. I would phone up all my direct debits. I'd phone up my mortgage company and say, look, I've lost my job. Can I get a mortgage holiday? And I'm pretty sure they won't say no because I've been paying it for the last 4 years. So I'd reduce all my outgoings as much as I could and then go job hunting, find a job. And like, that's how, like, I've always assessed the kind of financial side. The worst case scenario is like, I know I can get a job. I think there's probably a turning point now. And certainly at the start of this year, Rebecca and I sat down because Rebecca wanted to start a business. That was a massive decision. That was a massive risk, because we looked at Rebecca going back to work this year to earn a second income. That would obviously bolster the money in the bank and bolster the opportunity to come for holidays. But we both agreed that I would support her and she would go on and do her kind of thing. But we're getting to the point where that end of the year is kind of coming to an end of the kind of the year test is in February. And do we continue with that, or do we invest more money in it, or does she go out and get another job? Still to be confirmed. But I don't know where I'm going with this.
Yeah, you're definitely rambling a bit, Neil. I'm not going to lie.
Good.
But basically, my question was kind of like, what are you doing now? And when I say future, I don't mean next year. I'm talking like in 25 years' time.
Oh, right, yeah.
Right.
So I've put the financial future on pause a little bit while Rebecca gets to do this test at the bakery, see how that goes.
Fair.
And then in 6 to 12 months' time, when we're still recording this podcast, I'll tell you about my future finances.
Right. Sounds good to me. But yeah, it's that future thing where I'm like, I think one of the big ones that I had a look at was, it's relatively easy. And I don't know if I was like subject to this I was listening to a podcast or whatever else, but start early saving, right? And start small. So it's the same thing where Olivia's got a junior ISA thing and we pay £25 a month into it. And I don't know if she'll listen to this when she's 18, maybe she will. But basically, by the time she's 18, it was going to work out at about 15 grand.
Yeah. So like, ever since you told me that, we've done the same for Isla, Ben and Lewis. So there is some financial planning.
Yeah. And that's the kind of thing.
I've got a good pension.
And then for me, the health aspect of things, then it reminds me to want to go for a run. Like I've been to the gym twice this week. I went for a run on Saturday. You know, I keep reminding myself that I know that I can't necessarily see it now, and it's not the ripped, shredded Gordon that I was once, or the really strong one. But I know now that maintaining that, at the very least, maintaining a level of health to be able to go for a run for a 5K or to lift some weights, to me, that's investing when I'm 80. You know, it's really thinking about that, because I assess the risk by simply looking at the older generation now, to some extent, or older generations that haven't exercised or had the access to it, whether through education or whether through finances or whatever else. I can see the implications of a sedentary lifestyle, and I don't want that. You know, the downside of sitting on my ass doing nothing outweighs me actually getting up and go for a run for half an hour.
Yeah, and like I want everyone that's listening to this has either got a child or doesn't think about that, because I look at my father-in-law and his brother, they're in their 60s. His brother is still running up mountains. William is still very active and is amazing with the grandkids. And it's just like that kind of person I want to keep in the back of my head, is like, this is why I'm going for a run. This is why I'm doing my 10,000 steps. This is why I'm eating my vegetables.
Yeah, so I think, you know, my takeaway from this, I guess, or my piece of advice is, you know, look at an asymmetrical aspect of a risk. You know, what can the upside be and what can the downside be? And does the upside ultimately outweigh the downside? So feeling uncomfortable, for example, about moving to London. Okay, well, what are the prospects? Because I'd meet lots of different kind of people. I'd earn more money. Like all these kind of things compound on top of that. So when you do that assessment, if the upside is better than the downside, or it will be better than downside, why are you not doing it? You know, and then the other aspects of it, like look deeper into how you are assessing things. When you're buying a car, like we kind of talked about that, like why are you buying it? And keep saying why, and then break down all of the aspects of a car that you might not have thought of, or try to think about them. Where, okay, you've got your monthly payment that you might buy your Range Rover with. Okay, well, how much is servicing on a Range Rover? £500. You need to do that once a year. How much is insurance? Okay, that's £2,500 a year. How much are the tires? You know, if something goes wrong, how much is that? Like all these types of things. Like it's trying not to just be like, I want this thing, I'm going to have it. It's a case of, well, right, let's break it down a little bit. What are the actual costs? And think, just stop and think about it, I guess. It's like, I don't know why this is an example, but they have a gun. I think they have a gun law in Miami where you can buy a gun, but you also have a 24-hour breathing room before you're allowed to actually pick it up.
Wow. That's weird.
Well, it's just in case someone's having a mental breakdown and they go and buy a gun, Neil.
Yeah, no, I get that, but who's monitoring that 24-hour period?
Oh, it's the gun seller people.
Okay, fair enough. There is a saying where, like, if you want to buy, it doesn't have to be expensive, but buying anything, like, think about it and then wait a week and then come back to it. And do you actually want it again?
There's two that I do, and I do these with Laura sometimes. One in particular is like Amazon Prime Day. There's actually a website for this somewhere where you can look at, is the price of something on Amazon Prime Day at higher or lower?
Yeah.
But basically, would you buy it when it's not on sale at full price? And if the answer is no, then why are you buying it at half price?
Yeah.
And then the second,
or how have you lived with it without it for this long?
And then the second one is, can you afford to buy it twice? And again, if the answer is no, then there should be some sort of assessment and consideration why.
Yeah.
All right. Any useful knowledge or bestowing of wonderful Stoic philosophies today, Neil?
I actually wish I referenced this at the start, but it's completely off topic. Nothing to do with risk.
Oh, amazing! Can't wait.
Found an amazing new podcast, which might surprise you of who's in it. It's on Spotify. And it's Barack Obama and Bruce Springsteen.
Barack Obama and Bruce Springsteen are doing a podcast.
And they're talking about dad life. They're talking about financials. They're talking about managing risk. It's mad. Like, and it's one of the best listens of.
What's it called?
Yeah, one of the best podcasts. Renegades in America or something.
Renegades in America. Trying to find it.
Just put it up.
Yeah, Renegades Born in America. Spotify original.
That's it.
Oh, so this is like, they've obviously paid them to do this.
And I like, there's no adverts on it. There's nothing.
Oh, brilliant.
Like,
I shall
so good.
I shall follow that podcast. There we go. I'll give it a listen. Excellent. Great, Neil. Thank you very much. I don't think I have any podcast recommendations. There's one called the Iced Coffee Hour with a guy called is Alex Hormozy. Alex
Check that out.
Hormozy. Yeah, Hormozy. He was on the Iced Coffee Hour, and I think I sent it to Neil. Whether he's listened to it or not, I don't know yet. But it was absolutely fantastic.
Oh, no, you did about the... Yeah, no, I did listen to it.
Yeah, crazy. Just, to me, maybe we can get into it at some point, but to me, the mindset of entrepreneurs that sell companies for like $100 million is insane. Like, utterly. It's not insane. No, it's not insane, because it's not a differing path that I've gone down necessarily. But there's just, some people have it and some people don't. And... when you listen to this guy talking about businesses and building businesses and whatever else, he was a mix of intelligence plus doing, and just insane.
Mad.
Insane. Anyway, Neil, I think we could probably call it a day on that one. But hopefully we got through some topics. That was pretty quick, actually. We've been chatting for over an hour, which is mental.
Wow.
Yeah. But either way, if you enjoyed this podcast, follow us obviously on all the usual podcasts. We'll be listening to somewhere if you're listening to the podcast, for crying out loud. But if you're watching on YouTube, then you can also check us on any of the podcast platforms. And like I said as well, we have a YouTube channel. So you can go and watch our beautiful faces, our shiny foreheads, and Neil's light going on, which he decided to comment on halfway through the podcast, which he's surprised about. And we've also got like our 360 ones, which are pretty cool there as well. We have an Instagram page as well, which never gets posted to, so don't worry about it if you don't want to follow it. It's Developing Dads. But yeah, if you want to check it out, feel free to check it out. And I think that's it, Neil. Have I covered everything?
Yeah, decent. Thanks for listening.
Decent. Okay, decent. All right, see you later. Bye.
Goodbye.